Why are you working so hard to pay off your mortgage, your car loan, and your credit card debt, while the rich seem to be borrowing more and more? It feels backward, right? We're all taught that debt is a trap, a financial burden to be avoided at all costs. But what if I told you that for the wealthy, debt isn't a burden? It's their most powerful tool for building even more wealth. Today, we're going to pull back the curtain on one of the biggest secrets of the rich. This isn't about shady dealings. It's about understanding how money really works. By the end of this video, you'll see debt in a completely new light, and you might just start using it to your own advantage. So, what's the first thing we need to understand? It's the crucial difference between good debt and bad debt. This is the foundation of the entire strategy. Bad debt is probably what you're thinking of right now. It's the money you borrow for things that lose value or don't generate any income. Think about that new phone you put on your credit card. The second you walk out of the store, its value drops. The same goes for that fancy car you financed. These are called depreciating assets. You're paying interest on something that is becoming worth less and less every single day. This is the kind of debt that drains your bank account and keeps you stuck in the rat race. It's a consumer trap. The rich, on the other hand, actively avoid bad debt. They don't finance their lifestyles with high-interest credit cards. Instead, they focus on acquiring good debt. So what is good debt? It is money you borrow to buy things that either go up in value or generate more money than the cost of the loan. These are called appreciating assets or income-producing assets. Imagine borrowing money to buy a rental property. That property is an asset. It generates monthly rent, which can cover the mortgage payment, taxes, and other expenses. Anything left over is positive cash flow in your pocket. Plus, over time, the property's value is likely to increase. You're using the bank's money to build your own wealth. This is the absolute core of the strategy. Let's break this down with a simple example. Let's say you have $100,000 in cash. You could use it to buy one rental property outright. Let's assume this property brings in $1,000 a month in profit after all expenses. That's a great return. But what does a wealthy person do? Instead of buying one property with cash, they use that $100,000 as a down payment for 5 properties, each worth $100,000, assuming a 20% down payment. They borrow the other $80,000 for each property from the bank. Now, let us say each of these 5 properties generates just $200 a month in profit after paying the mortgage and all other costs. But wait, it gets even better. Let's talk about inflation. We all feel it at the grocery store. The value of our money seems to be constantly shrinking. A dollar today buys less than it did last year. For savers, inflation is a silent wealth killer. That cash you have sitting in a savings account is losing purchasing power every single day. But for borrowers with fixed-rate loans, inflation is a secret superpower. Think about that mortgage you took out. Let's say your monthly payment is a fixed $1,500. Today, that might feel like a significant chunk of your income, but in DS or 20 years, thanks to inflation and hopefully wage growth, that same $1,500 payment will feel much smaller and easier to pay. You're essentially paying back your loan with cheaper and cheaper dollars over time, while the value of the asset you bought your house is likely increasing. The debt is fixed, but the value of the asset and the income it can generate are not. The rich understand this game perfectly. They lock in today's debt and let inflation work its magic, effectively reducing the real cost of their borrowing over the long term. Now for the third, and perhaps most mind-blowing reason the rich love debt: the tax advantages. This is where it gets really interesting. In most countries, the interest you pay on debt used for investment purposes, like a mortgage on a rental property or a loan for a business, is tax deductible. What does that mean? It means you can subtract the amount you paid in interest from your taxable income. This lowers your total tax bill. So not only is the bank's money helping you buy an asset that makes you money, but the government is also giving you a tax break for doing it. Let's go back to a rental property example. The interest you pay on that mortgage is an expense you can deduct. You can also deduct property taxes, insurance, repairs, and even depreciation, which is a known cash expense that represents the wear and tear on the property. All these deductions can significantly reduce your taxable rental income, sometimes even to zero. You could be collecting cash flow every month while legally telling the taxman you made no profit. This is a massive advantage that people who only earn a salary simply don't have. They get taxed on every dollar they earn, while investors who use debt can build wealth much more tax-efficient. So, let's put it all together. The wealthy use debt as a three-pronged strategy. First, they use leverage other people's money to control more assets and amplify their returns. Second, they use inflation to their advantage, paying back their fixed loans with money that is worth less over time. And third, they take advantage of massive tax deductions on the interest they pay, which lowers their overall tax burden. This isn't just about real estate. The same principles apply to starting or expanding a business. A business owner might take out a loan to buy new equipment that will increase production and profits. The loan interest is a tax-deductible business expense, and the new equipment generates more revenue than the cost of the debt. It has the same good debt formula. Use borrowed money to acquire an asset that pays for itself and then some. Now, before you run off to the bank to borrow as much as you can, a crucial word of caution. This strategy is not without risk. The key is managing that risk intelligently. The rich don't just borrow recklessly. They are meticulous about their numbers. They ensure that the income from the asset will comfortably cover the debt payments, with a buffer for unexpected vacancies or repairs. They study the market to buy assets in areas with strong growth potential. They secure low, fixed interest rates to protect themselves from rising costs. Using debt magnifies gains, but it can also magnify losses. If you buy a bad asset in a bad market with a bad loan, you can lose money very quickly. That's why financial education is so important. You must understand how to analyze a deal before you ever sign on the dotted line. So, the next time you hear someone say stay out of debt, remember that's only half the story. It should really be stay out of bad debt. Learning to distinguish between debt that makes you poorer and debt that makes you richer is one of the most important financial lessons you can ever learn. It's about shifting your mindset from that of a consumer to that of an investor. Instead of borrowing to consume, you borrow to acquire assets. This is the fundamental secret the wealthy use to build and accelerate their fortunes, generation after generation. It's not about being a financial wizard. It's about understanding the rules of the game and using them to your advantage. Thank you so much for watching. I hope this has opened your eyes to a different way of thinking about debt. If you found this valuable, please hit that like button and subscribe for more content that helps you build real wealth. Let me know in the comments what you think. Is debt a tool or a trap? I'd love to hear your thoughts. See you in the next video.